I now believe this is our 11th presentation. In the idea we're presenting today is Lyft, the rideshare company, and we'll turn it over to Brandon to run through the thesis and we can address questions at the end.
Thanks, Eric. So yeah, let's just hop right into it. So as they mentioned, and I think a core part of our investment strategy is to focus on good businesses where we see upside estimates, see where the consensus is, see where we differ. So we thought we'd just jump right into where the consensus estimates and where do we differ. And then we can get into more longer depth part of the thesis. But we find very interesting about Lyft is, it's bearishly positioned on the sell side, meaning there's more holds and sells than there are buys. And the buy side is, 14% short. They tend to go long Uber and then just, instinctively want to pair trade Lyft short. A lot of it has to do with the positioning within the autonomous vehicle market. But what we find really interesting is, heading into this Q2 2025 print, we expect it to be on August 7th. We see Lyft tracking towards the high end of their guidance. This is just based on the third-party data sources that we have access to. And, so they guided to 10 to 14% bookings growth. Consensus is slightly below the midpoint. And, we think they will at least hit the high end, if not exceed the high end of that 14% bookings growth. The consensus is a little bit light on gross profit. That's been an area of consistent upside. So, while consensus thinks that adjusted EBITDA will be, about 2.8% of gross bookings, we think just, operating leverage, higher gross margin through faster growth, we'll put it to, about 3% of gross bookings. And that's how you get about, 9% upside to adjusted EBITDA in Q2, exceeding the high end of guidance. Okay. Now just jumping into the investment thesis. So Lyft has come a long way. We had a CEO change about 2.5 years ago, David Reijer. We're a really big fan of his. He's just done an absolute phenomenal job, repositioning the business, focusing it, and getting it back on track. All the KPIs you could think of, riders, drivers, the ETAs to pick up people is now at all-time highs. So when we're evaluating this business, there's a few things that really popped out to us. It's asset light. They are just the app who controls the network. So we're really just earning a take rate on people, taking ride shares. And, a big portion of people taking ride shares is just commuting, people going to work, airports. Lyft is actually very big in healthcare, so doctors' visits is very important. And then people just going out, they call it, the Friday night scene is really big for ride shares. And that's all very, I'd say like consistent businesses, consistent drivers of demand, especially with car ownership starting to not be as popular with the younger generation. They're starting to take more ride shares. And this business just naturally, it has about $100 million of float income. And the float income is for every rideshare, they have to reserve just, ballpark it $1 of insurance reserves. But they don't pay those insurance reserves out for, generally speaking, 1 to 3 years is when the bulk of it will get paid out. 100% will get paid out, generally speaking, within 7 to 8 years. But because we have a overcapitalized balance sheet and no debt, well, very minimal debt, it's just converts. We get this just pure $100 million of float income. So there's free cash flow tends to exceed adjusted EBITDA. And part of that is because we have the float income, zero net CapEx. And the CapEx that's net is we also do scooters, we call it light vehicles. So it's scooters and bikes. But they tend to sell the old bikes to buy new bikes. And because that business is not growing as much, it tends to net out to about zero over time. And then, management gave, their guidance for 2027 at the Analyst Day last year. That got us really excited. We think it's achievable. Certain metrics very achievable, particularly the $900 million of free cash flow. They already exceeded that, and on the LTM is over $1 billion of free cash flow. So we're kind of there already. There's a couple one-time items, but you think about a $6-7 billion market cap company that's already doing $1 billion of real free cash flow in the LTM, and should it do over $1 billion, we think in 2027, valuation here is very compressed. And the business, you would assume with a valuation like that is, it's going to either go away in a few years, or it's not growing, or it's not profitable. But none of those we believe to be the case. And part of the turnaround here was we're going to refocus this business on U.S. rideshare. We got to do the core business first. That kind of had been neglected over the years because they tried to do too much, the prior founders. But now that we have that business stabilized and thriving, there really is a potential to move into more categories like Uber's in positioned in. Food delivery, pharmaceutical delivery could be a very natural extension to what they do. And all these really good things that we've just mentioned, and we have a very bearish, buy side and sell side. So that's really where there's like an opportunity here. So why are they bearish? They're bearish because of the advent, or really the accelerating growth of autonomous vehicles. Waymo being by far the biggest. And if we kind of back up here, maybe 9 months ago, there was a really big threat that there would be disintermediation, meaning Waymo would just go direct to the consumer. You'd call this autonomous vehicle on your app, and you'd really have no need for a Lyft rider. How it's kind of evolved, and I think this is becoming more and more consensus by the month, is Waymo is pursuing a hybrid network. They've said that they need to use a partnership approach. So eventually, we're very optimistic that Lyft will receive a Waymo partnership. And there's a debate too. Okay, are AVs right now cannibalizing the rideshare market? We don't think so. We think it's been very TAM expansive. A lot of commentary suggests people are just doing it as almost a novelty, like, hey, look how fun this is. I'm in the back seat of a car with no driver, cruising around, downtown San Francisco. Really, what we see though is, Lyft, we believe, will likely win an AV partnership, or if they're not going to win a Waymo partnership, which is Google, we think there's a strong connection and strategic rationale for them to be acquired by Amazon, which is, they have Zook, which is a really quickly up and coming competitor in this autonomous vehicle market. And then I think, last point on that, what the market is missing is there's frequent, I'd say, panics from investors that Lyft is losing market share, Uber and Waymo. We think they're actually gaining market share. And we think they're gaining market share by having better pricing and lower ETAs, meaning the car's coming faster and you're not being charged as much. You can fact check this really quick. Just pull up your Uber app, pull up your Lyft app, do a price comparison, to the airport, to your friend's house, to, work, and you can kind of see for yourself. So catalysts, there's plenty of catalysts here. There's no shortage of news flow around Lyft. But we had the Tesla Robotaxi launch on Sunday. I think that was a little bit underwhelming. It went fine, but it's been underwhelming, and there's been some hiccups along the way. So, that I don't think we don't believe that to be as near term of a risk. Maybe even not even like a medium term risk where we can start losing market share to them. As we mentioned, Lyft is very well positioned as being the number 2 player with 30% market share to win a major AV partnership. And that right there, we think will